Welcome to Smart Investing Psychology, an initiative by Market Research Universe's team, where we help you master the art and science of investing. In this episode, we're diving into one of the most important topics for anyone in their 20s, how to start investing in India. Whether you're fresh out of college, starting your first job, or figuring out how to manage your money, this roadmap will help you lay the foundation for a financially secure future. Your 20s can feel like the time to enjoy life, explore new opportunities, and embrace freedom. But what if I told you it's also the best time to start your financial journey? You may not be thinking about retirement now, but your future depends on the decisions you make today. Why should you start investing now in your 20s? The simple answer is time. You have an advantage that older generations don't: time. Let me introduce you to the concept of compound interest. Here's a quick example. If you invest 1,000 rupees a month starting at age 22, by the time you're 50, you could have over 50 lakhs, assuming an annual return of 10%. If you wait until you're 30 to start, you'd need to invest more than double that amount to achieve the same result. That's the magic of compound interest. Your money earns money, and then that money earns money too. So investing early gives you more time to grow your wealth with minimal effort. And in India, with inflation rising, it's even more crucial to make your money work for you rather than lose value sitting idle in a savings account. Let's take a real-life example. Rakesh Jhunjhunwala, often called the Warren Buffett of India. He started investing in his 20s with just 5,000 rupees, and today his investments are worth billions. How? Consistency, patience, and understanding how to build wealth over time. He didn't achieve success overnight, but he was patient, stuck to his investment principles, and avoided chasing quick profits, something we'll talk more about later. Before you even think about where to invest, you need to know why. What are your goals? Maybe it's saving for a new car, buying a home, or building a retirement fund. Setting clear financial goals helps you prioritize your investments. Break down your goals into short-term, which is 0 to 3 years, medium-term, which is 3 to 5 years, and long-term, which is 5 years and beyond. For example, short-term could be saving for a bike, medium-term for a home down payment, and long-term for retirement. Once your goals are clear, it's time to budget. Apps like Grow and Upstocks can help you track your spending and ensure you're saving enough to invest. A simple approach is the 50-30-20 rule. 50% of your income goes to needs, 30% to wants, and 20% to savings and investments. Before we dive into the how of investing, let's talk about protecting yourself first. In your 20s, life can be unpredictable. That's why building an emergency fund should be your first priority. Aim to save enough to cover 3 to 6 months of expenses. Why? Because life happens. You might lose your job, face medical emergencies, or need to move cities for a new opportunity. Keep this money in a safe, liquid investment, like a savings account or liquid mutual fund, so it's easily accessible. Now that you've got an emergency fund and a budget in place, let's talk about where you can actually invest your money. There are plenty of options available in India. I'll walk you through the most popular ones. Equity mutual funds pool money from multiple investors and invest in a variety of stocks. For beginners, index funds and large cap funds are good places to start. They offer diversification, and you don't need a lot of money to begin. You can start investing with as little as 500 rupees per month via a systematic investment plan, or SIP. Let's take Mirae Asset India Equity Fund, a popular equity mutual fund. Over the last 5 years, this fund has delivered an average return of around 15%. If you had invested 10,000 rupees per month for 5 years, you would have over 9 lakh rupees today. Next up is the Public Provident Fund, or PPF. This is a government-backed, long-term investment scheme that offers guaranteed returns. The lock-in period is 15 years, and the current interest rate is around 7 to 8%. It's a great option if you're looking for a safe, tax-saving investment. Now let's talk about something you need to avoid: option trading and betting. I know a lot of people, especially in their 20s, are drawn to these because they think it's a quick way to make money. But the truth is, it's a dangerous game. Option trading is extremely complex. Unless you have deep knowledge of the market, you're more likely to lose money than make any. Similarly, betting on stocks or sports isn't investing, it's gambling. It preys on emotions like greed and fear, which can lead to addiction and even debt. Instead of chasing short-term thrills, focus on long-term wealth-building strategies. Consistency and patience are the keys to success in investing. Diversification is one of the most important principles of investing. In simple terms, don't put all your eggs in one basket. By spreading your investments across different asset classes, like equity, debt, and gold, you reduce the risk of losing everything if one investment goes south. Let's say Anik, a 25-year-old software engineer, invests Rs. $10,000 every month. He allocates 70% to equity mutual funds, 20% to PPF, and 10% to gold ETFs. Over time, his portfolio grows steadily because he's diversified, which protects him from the ups and downs of the stock market. You don't need a lot of money to get started. SIPs allow you to invest small amounts like Rs, 500 or Rs, 1,000 per month. The key is consistency. By investing regularly over time, your small contributions can grow into a significant amount thanks to the power of compounding. Finally, remember that investing is a journey. Review your portfolio every 6 months or annually, and adjust as needed. Maybe you need to increase your equity exposure as your risk tolerance grows, or move more into safer assets as you approach major life goals. Here are a few mistakes to avoid in your 20s. Skipping your emergency fund. Trying to time the market. Following stock tips or trends without research. Not diversifying your portfolio. Investing in your 20s is the best gift you can give your future self. With the right mindset, strategies, and patience, you can build wealth steadily over time. Thanks for watching. If you want to learn more about stock market trading or need help with market research, check out our stock market trading courses and market research services at www.marketresearchuniverse.com, where you can explore more resources and even get in touch with our team directly. We're here to help you become a smart, confident investor. All right, that's it for today's video. I hope you found this beginner's guide to smart investing helpful. If you enjoyed this video, make sure to like, share, and subscribe, and hit that notification bell so you never miss out on the latest from Market Research Universe.